money in 5 years, let us take a look at some of the investment strategies you can implement and also the risk involved in this objective. This might seem like an exciting proposition, but it's also very challenging because high returns usually come with high risk. So, is it worth the gamble? Let us find out through an in-depth analysis in this video. Hi, welcome to holisticinvestment.in. We help individual investors like you to take the right financial and investment decisions to reach your financial goals in a faster and smarter way. So, how much return to double in 5 years? So, if you have a medium term financial goal and want to double your money in 5 years, then you need investments that offer an annualized return of at least 14.4% because these returns also needs to be higher when you adjust it for inflation. So, mutual funds are a good investment option that can help you achieve such returns. So, are you ready to explore mutual funds to meet this goal? Is achieving a 15% return possible? It might be possible, but it is still quite challenging. A more realistic target would be around 12% per year. And equities and equity mutual funds are your best option for such returns as they have historically performed well. But, however, they are also known for their volatility. So, are you prepared to endure the market's ups and downs to pursue these returns? If you choose equities by directly investing in stocks, it can bring high returns, but it also requires careful choice, good timing, and a strong stomach for volatility. Can you handle the market's ups and downs? And if you choose to invest in equity mutual funds, these funds usually pool money from many investors to buy a mix of stocks. So they reduce some risk of individual stocks but still follow the market movement. Can you accept the fluctuations for potential gains? Is this something you can do? Maybe you can double your returns by investing in equity and equity mutual funds. But how many years does it take for your money to double? There's a simple thumb rule for this which you can use to find out the answer. The rule of 72. So according to this rule, you divide 72 by the estimated annual rate of return to determine the number of years it will take for your money to double. For example, suppose you want to invest 50,000 rupees in an investment with 12% interest rate. By dividing 72 by the interest rate, which is 12%, you get 6 years. That means it will take approximately 6 years for your 50,000 to become 1 lakh if the interest rate remains the same. So if you want to double your money in 5 years, you need an annual return of about 15%. But if you want to take not so much risk and you want some kind of safer investment, then you can opt to invest in fixed deposits or bonds, which offer lower returns. So it might take around 10 to 12 years to double your money. But are you okay with waiting longer for a more secure investment, or do you prefer taking a risk for faster growth? But there is also an option of balancing risk and reward. Because let's face it, investing 100% in equities to chase a 15% return is really risky because market is highly unpredictable because market crashes can happen due to economic issues or even global events can all hurt stock prices. So are you willing to risk losing a lot of money for a chance of higher returns? If you invest in safer investments like fixed deposits, bonds, or government securities, your money won't double in 5 years, but it still offers you stability. But do you prefer stability over high growth potential? What if we take a different approach? What if we take a balanced approach by combining equity and debt? This might help us figure out how to balance the risk and reward concept. Because having a more balanced approach, which involves mixing equity and debt instrument in a 50 is to 50 ratio split, can provide us with growth and stability. You can invest in equities through SIPs over 2 to 3 years, which can help reduce market risk because this method benefits from averaging out the purchase price during volatile markets. And you can also choose to invest in debt investments like bonds, fixed deposits, and debt mutual funds alongside, which offer predictable returns, though lower than equities. But here they provide a safety net against the risky parts of your investment portfolio. So, do you like the idea of having a safety cushion? And as a steady, systematic investment like SIP more your style, then combining this both might give you a balanced approach. So, what are the projected returns? Let's take a realistic perspective. Let's assume a 6 to 7% returns from debt instrument and 11 to 12% returns from equities. you can realistically expect a blended annual return of 9 to 10%. So over 5 years, this means a 50 to 60% increase, not doubling, but 50 to 60% increase. For example, if you invest 10 lakh rupees today in this combination, it might grow around 16 lakh rupees. Does this realistic growth satisfy your financial goals? But what if you're willing to take more risk? As an investor, if you're willing to take more risk and you don't need money for essential expenses and can tolerate more risk, then you could allocate 70 to 75% of your portfolio to equities. Even then, aiming for a 15% annual return is very ambitious and risky. So, are you ready to face possible losses for higher potential gains? So, what are our final thoughts in exploring investment strategies and potential risk involved in doubling our money? Doubling our money in 5 years is a tempting goal, but it comes with significant risk. So, is the potential reward worth the possible volatility and losses for you? Because for most investors, a balanced strategy which combines growth potential with risk reduction is a more sensible approach. Because by setting realistic expectations and diversifying your investments, you can achieve solid growth without jeopardizing your financial security. But at the end of the day, it all comes down to what kind of investor you are. So, if you want to chase high returns or if you want to aim for steady, sustainable growth, it depends on your risk tolerance and financial goals and in which time frame you want to achieve those financial goals. So, if you have doubts regarding which investment strategy would work best for you, it's better if you consult with a certified financial planner who can look at all possible angles and craft a personalized investment strategy which will make it hassle free and smooth for you. So it's better if you involve a financial planner in the long run of your investment journey to make it more smooth for you. You can also consider this option. If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.